Welcome to the deep dive. We cut through the noise. So if you've been watching the markets, you've probably seen it. Stocks, well, they've basically gone nowhere this past month, just stuck.
Yeah, pretty range-bound. And, our analysis points pretty clearly to the conflict between Israel and Iran as a big factor. These geopolitical things, wars especially, they just inject so much uncertainty. Markets hate that.
They really do. It's unsettling, no doubt. And that's exactly why today we're trying to put together a kind of playbook, a Middle East war and stock market projections playbook, if you will.
hmm
And the big question really is, what do you do when this stuff happens? Is hitting the sidelines the smart move?
Well, that's the mission, isn't it? To give you an evidence-based perspective. Because the gut reaction, the panic, well, our sources suggest overreacting often proves costly.
Right. So we're going to unpack the history, look at how markets behaved after dozens of these kinds of events, and then really zoom in on past Middle East tensions to see if there are specific clues there. Basically, figure out if history says get out or something else.
Exactly. We need that data-driven view.
Okay, so let's get into it. The sources pulled data covering 35 major geopolitical events going all the way back to 1979. And these aren't small things, right? We're talking market crashes like 87, debt downgrades, banking crises, and yeah, wars. Big stuff.
Significant shocks. And what the S&P 500 did after these events, on average, is pretty revealing. What's really striking is the pattern. You see, historically, the S&P 500, it usually only sees pretty modest declines right after the shock. Near term, yeah, a dip. On average, maybe negative 0.5% after 1 month.
Only 0.5%, okay.
But then it recovers, almost like clockwork.
Right.
It really suggests that, the long-term economic stuff tends to win out over the immediate kind of emotional headline reaction. Smart money often sees those dips as, well, opportunities.
That's fascinating. So a small dip, then recovery. What do the numbers look like further out?
Well, after 3 months, the average gain is around 1%. 6 months out, it's 5.2%. Go out 12 months, you're looking at 9.2% average gains.
Wow.
And even further, 24 months, it's a pretty substantial 20.3% return on average.
So that initial wobble, it really is just temporary before a pretty solid rebound kicks in. It feels counterintuitive, doesn't it? Headlines are screaming danger, but the market seems to, I don't know, shake it off relatively quickly.
It does. It speaks to a certain resilience. But, okay, that raises the question, are Middle East conflicts different? Given the energy connection, the specific regional stability concerns, do they cause a unique, maybe longer-lasting drag?
That's exactly where we need to drill down. So we took that broad history, those 35 events, and then specifically isolated 6 prior Middle East conflicts.
Which ones?
Okay, so we looked at the Second Gulf War back in March 2003, then the Israel-Hezbollah War in July 2006. More recently, the Soleimani assassination in January 2020, the Israel-Gaza conflict in May 2021, the Hamas attacks last October 2023, and the recent Iran attacks on Israel in April 2024. A pretty focused group.
Right, a specific subset. And interestingly, while it's fewer data points, the performance after these specific 6 events, it was actually even stronger than the average for all 35 geopolitical events.
Stronger, really? Okay, tell me about those numbers.
Yeah, stronger. 1 month later, after those 6 Middle East conflicts, the S&P 500 didn't dip. It actually gained 1.2% on average.
Whoa, okay.
3 months later, up 2.8%. 6 months out, a jump of 12.1%. And 12 months later, it was up 15.3% on average across those specific events.
That's quite a difference from the general geopolitical average. Any idea why? What do the sources suggest might be behind that stronger performance?
It's tough to nail down one single reason, obviously. But the sources float a few ideas. Often these events, as awful as they are, they tend to be somewhat contained geographically. The market seems to price in that initial shock very quickly. Think back to, say, 2003, the Iraq War. The headlines were intense, but the sources show if you acted just on that fear, you'd have missed some really significant gains just a few months down the line. The market tends to look beyond the immediate noise, you see, towards the longer-term fundamentals.
Okay, so the history paints a pretty clear picture. Resilience is the norm, maybe even more so with these specific conflicts. But just knowing that isn't quite enough, is it? The real trick is how you actually use that knowledge, how you stay level-headed when things feel chaotic. What kind of practical strategies do the sources recommend for navigating this?
Well, they really stress 2 main things. First, and this is key, don't overreact. Don't trade every single headline. Instead, you need objective tools. They mention monitoring conditions with powerful indicators, specifically their own big money index.
Big money index, right? How does that help?
It tracks what the large institutions, the big players, are doing, buying or selling. So it gives you a signal about the underlying money flow, where the smart money is really moving, not just what the news is shouting about.
Okay, so follow the big money, not just the noise. Makes
Yeah.
sense. What's the second strategy?
The second thing is to actively look for what's actually working under the surface. Even when the main indexes look flat, like they have recently, remember, we're still technically in a massive bull market overall. There are always individual stocks, maybe in specific sectors, that are seeing constant buying from institutions.
You mean like professional money managers are consistently adding shares, showing they have long-term belief?
Exactly. That's institutional sponsorship.
Mm.
And finding those names is crucial. This is where understanding the big secular trends really helps, like long-term shifts. For instance, the research highlights nuclear energy right now. It's a growing theme, seen as pretty resilient.
Nuclear, interesting.
Yeah, and while you might get some, speculative stuff in that space, the sources pointed to one specific top-quality nuclear company. It's got a healthy fundamental outlook, solid balance sheet, and crucially, it's seeing those consistent big money inflows we talked about.
Ah, so it's an example of an outlier stock. Something doing well even when the broad market isn't going anywhere.
Precisely. And this particular stock, they noted, it popped up on their Outlier 20 report.
Ooh.
That report specifically flags companies showing exceptional institutional interest and strong technicals, even when the market's broadly hesitant.
So it's about finding businesses that are maybe essential or have strong financials or are riding these big long-term waves regardless of the day-to-day news.
That's the idea. Focus on quality and where the big money is quietly accumulating.
Okay, let's quickly recap the key takeaways then. So the big picture, data from 35 major geopolitical events since 79 shows the S&P 500 dips only slightly near term, like at minus 0.5% in a month on average. But then recovers pretty solidly, 1% in 3 months, 5.2% in 6, 9.2% in 12, and over 20% in 24 months.
Right. Importantly, when we zoom in on those 6 specific Middle East conflicts, things like the Gulf War, Soleimani, the recent Iran attacks, the performance was even better. The S&P actually gained 1.2% in the first month, 2.8% in 3, 12.1% in 6, and 15.3% in 12 months on average.
So the practical advice boils down to don't panic sell. Keep an eye on objective market indicators, like that big money index you mentioned, to see what institutions are doing. And maybe most importantly, look under the surface. Find those outlier stocks that are thriving anyway. Remember that bull market is still out there. And themes like, say, nuclear energy, with quality companies showing good fundamentals and attracting big money, like that one on the Outlier 20 report, that's where opportunity might lie.
Exactly. Which leads to maybe a final thought for you to consider. What if the real edge in these uncertain times isn't really about reacting instantly to every breaking news alert? What if it's more about, patiently understanding these historical patterns we've talked about and then finding those specific outliers where the smart big money is quietly building positions, even when everything on the surface seems flat or unsettling?